Good afternoon, everyone. Welcome to this afternoon's Open to Export webinar on exporting essentials, how to finance your orders. My name's Was Rahman. I'm with UKTI. My colleague who's going to be sitting silently running this is Sean Williams, and we've got three excellent speakers from NatWest, RBS Group, UK Export Finance, and Billbus. You'll be hearing in a few moments from the speakers, but before we get to our speakers, let me talk you through some housekeeping just to make sure that everyone can hear. Just trying to click onto the next slide. There we go. So most of you should see the page on the PowerPoint that's now come up that talks about participation. There's an instruction that explains how you can hear me and our speakers. You can either use your computer with the microphone and speakers button, or you can press the telephone button and dial in on the number that's provided. Once you do that, you should be able to hear us loud and clear. And it looks like we've got most of our attendees that have registered signed up. So let's get straight into it. As you hopefully all know, this has come to you through the Open to Export service. It's a mechanism by which UKTI, HIBU, and a number of experts, advisors, and supporters of the UK SME audience help you with exporting. And so it's a resource where we'd really encourage you to register online. One of the main reasons for doing that is that particularly after a webinar like today's, there's an awful lot of questions that people tend to have. If you register with Open to Export and then come back with your questions that you've got after this, you'll find that there's an awful lot of answers that come through, and we find that the combination of listening to the webinar and then registering afterwards gives people quite a lot of insight. But let me move on to the content of today's session. We're going to be talking about one of the most important questions that people find when we're talking to them about export in the SME community, which is primarily how you get paid. To give our speakers a bit of a sense of who we're talking to and how much experience you have, if you could start off with the poll that's just about to come up in front of you, which is how experienced you are at exporting. You should get a choice of three answers to give us a sense of whether you're experienced, just starting, or completely new. And once we've got that, that allows our speakers to direct their comments and the questions accordingly. While we're waiting for that, if I could just point out that you should have an option on your screens to ask questions. At any point in time, if you'd like to type in a question, then I'll be making sure that those get fed into the speakers while we're talking. This is not the same webinar as Tuesday. We've got a series of three that are going on, and this is much more geared towards the specifics of how to get paid to finance your order. And if we get into those, then you'll start to see those of you that attended Tuesday's webinar. Where are we? We're nearly done. What I'm going to do is close this in just a moment. What we're finding is that about half of you, if the answers come up, I just need to click the button. There we go. About half of you are new to exporting. The other one-third are experienced, with a few that have just started. Okay, so with that in mind, let me now move on to our first speaker. We've got Gordon Idden with us. Gordon is a Director of International Trade at NatWest and RBS Group. He's had over 30 years of experience, not just with the bank, but also working with Jardine Matheson and doing some international work in Hungary, and also with Aon Corporation. Gordon, if you'd like to spend a few minutes talking us through connecting a business to the world, really appreciate it. Thank you.
Yeah, thanks, Was, and good afternoon, ladies and gentlemen, and thank you for joining today's webinar. I think if we look at international trade, I mean, there's absolutely no doubt that this is a key focus for the government, for the banks, and also for companies, throughout the UK, with exports being a key driver for the economy. However, many companies, do have a real fear of trading overseas. Quite often it is out of their comfort zone, and there is definitely a difference between delivery round the corner and watching a container leave out some port for overseas destination. So from a bank perspective, this afternoon, what we will be doing is just taking a very whirlwind tour of some of these concerns, hopefully providing you with some ideas on how to mitigate risk, and also about obtaining additional funding requirements, to meet companies' challenges whilst they are trying to trade overseas. Now, I can see from the poll that we have a real mix of some experienced and some new to exporters. So we're hoping that all of you will have some benefit from the presentation. But in simple terms, international trade, if you are an exporter, it's not unreasonable for you to expect to be paid for either the goods or the service you've provided. And if you are an importer, all you want to do is pay for the correct goods that you have ordered. One thing I will say, as with any bank, there will be some lots of jargon that we use, and if any of that is unclear, then please do raise a question through the webinar. I'm just waiting to be able to click onto the next slide, and there we are. As far as the agenda is concerned, you can see that we've got the introduction, the concerns and challenges and mitigating risk, etc., trade cycle and working capital, how we can help, some helpful solutions and questions and answers. So potential challenges for companies trading internationally, and if you look at the top two, we've got time and distance. That is very much interlinked, and I think as any company you will have to accept that if you are selling overseas or you are buying goods from overseas, then the time frame will change, and that is something where I will be talking about the trade cycle, which is a vital part of international trade. Local business customs and practices. There are organisations out there who will help, in terms of the communication, the accountancy side of it, and the legal profession are there to help as well. And I think the advice on that is having a good overseas agent is definitely worth their weight in gold, because they will understand, quite often those customs and practices. The ability of trading parties to meet their obligations. This is based around the performance, and if you are buying, it's the performance of your suppliers, and if you are selling overseas, then of course it is, if you are buying raw materials, then going into a manufacturing process, then of course you need to ensure that your suppliers are on side. Trust generally built up over a period of time, and quite importantly, with anything international, is will you have a plan B if something goes wrong, if you don't get paid or if your goods don't arrive. Logistics, absolutely vital to have a freight forwarder who is operating in the territories in which you are trading or in which you are buying. And insurance, quite often companies don't actually look at what their obligation is for insurance, and quite often that is very much linked to the shipment terms of whose responsibility it is to insure goods whilst on the water to the point that title has passed of those goods, whether it's import or export. So getting paid, absolutely vital. You export, you want to get paid for the goods that you have actually provided. And I think this is best summed up on this slide, mitigating risk. And this, we refer to as the risk ladder. And as you can see on the left-hand side, from an exporter's point of view, if you are selling on open account, then of course you do run the risk of insolvency of your overseas buyer. You also run the risk quite often of political risk of non-payment. So, on open account trade, it is normal method of trade, but it is identifying what those risks are, who it is you are dealing with, and maybe looking at some risk mitigants, perhaps the likes of credit insurance or bank guaranteed from your buyer's bank overseas. And right down to the bottom of that for an exporter, cash in advance. Absolutely fantastic from a risk point of view. If your buyer has paid you before you ship the goods, then there is no risk of non-payment. But do be aware that if your terms of payment are cash in advance, then you do run the risk of restricting sales opportunities, because it is your buyer overseas that then runs the risk of your performance. From an importing point of view, is totally the opposite. If you can obtain open account trade, fantastic, and if you can get that open account trade to meet with your own individual trade cycle, then of course that does mitigate your risk. You are able to obtain the goods before you pay. And then at the highest end of that scale for import, of course, is cash in advance, where you are looking at the performance and solvency risk of your supplier and also the relationship with your potential customer if you don't perform as a result of non-performance by a supplier. Now, you'll then see sort of in between that, those two open account and cash advance, term collections, site collections, unconfirmed LC, confirmed LCs. This is where the bank jargon comes in, and this is undoubtedly methods of risk mitigation by using instruments that are provided through the bank. And again, if you do have any questions on of those individual payment methods, then please raise a question. I mentioned trade cycle, absolutely vital. From a banking point of view, I spend the best part of my day drawing these trade cycles out because by being able to understand the trade cycle, it enables you to understand your timeline in terms of arrival of raw materials, your own manufacturing process, your shipment to overseas, and of course then linked into the payment terms that you have negotiated with your buyer overseas or with your supplier coming in. Absolutely vital, and albeit that's a very sort of straightforward trade cycle, what it does do is identify certainly that for a customer buying in raw materials to manufacture and export, to the point of payment from your buyer, you will see that sort of light blue line which becomes the funding gap. And again, from a bank point of view, there are very much a number of products that we provide to help companies with that.
Jordan, can I
what
just
support?
For a second?
Yes.
Okay, so we've got a little bit of questioning that particularly is coming from folks that listened to our session on Tuesday, because on Tuesday we went through the risk ladder, the various products that you had, and there's quite a lot of discussion on what the differences are between the different types of payment, term collection, unconfirmed LC, etc. And so if I understand right, you're going to be talking about what people can do to fill their funding gap once they've already gone with a particular type of payment. But quite a lot of people are wondering, is there much that the bank can help you with right up front when you're trying to negotiate with a customer to get something that's better for you rather than better for them? Because most people, especially the smaller firms, feel like they're going into their customers and they don't really have that much bargaining power. Is there anything the bank can do up front to help you make sure you get the most favorable terms in your contract so that a lot of this stuff becomes a lot easier?
Yeah, and I think that is a very valid question and probably relates to an awful lot of SME companies. Yeah, the banks, and not just ourselves, but all banks with an international department will be willing to sit down with a customer at the point that they are negotiating their contract. And quite often you can have a scenario where, for example, an overseas buyer wants extended terms of payment, but from a cash flow point of view, it doesn't help our customer getting his cash in. And again, what the banks will do is utilizing a whole number of these different types of mechanisms within the bank to help the buyer overseas with a payment period, and also help restore the customer's cash flow. And term collections give extended terms of payment with an accepted debt from the buyer, whereas a confirmed letter of credit, the overseas bank risk is taken away by the bank in the UK, actually making that payment to that customer on presentation of documents. So right at the start of the contract, absolutely crucial, if the customer comes to or goes to their bank, sits down with the contract that they are looking at, and you can then look at the trade cycle and look at those terms of payment being the best for the buyer and also for the customer, not for the bank.
Great, thanks.
Okay, so what support can banking partner provide? Well, I think I've almost answered that question then. But, managing risk, and I will be very careful how I pronounce this, but that is a great slide on your top left-hand side entitled Ship happens. So, things can go wrong. But again, from the bank's point of view, on behalf of the customer, what we're looking at doing is managing the risk and providing working capital. Understanding the trade cycle, I think I've already covered, and again, some sort of trade product jargon here. Import loans, letters of credit, invoice finance, bonds and guarantees all form part of that trade products that the banks provide, but all linked into matching the trade cycle, which we've already discussed. You will see a line there which says new forms of finance, UKEF-supported facilities. Now, I know my colleague will be discussing that in greater detail later. But other areas of support, if you're selling overseas with foreign currency, important that a company has a foreign exchange strategy and access to various international payment mechanisms, whether it's an electronic platform for delivering foreign exchange, letters of credit, or different bank instruments. From a global presence, certainly as a group we are in 36 countries, but what I wanted to do was just highlight Asia. Asia is one of those regions which has fantastic opportunities for UK exports into the likes of India, China, South Korea, Singapore, Taiwan, just to name a few. And albeit sort of Europe remains the main export market for the UK, with combined exports in the region of 42%, the sort of Asia and the Pacific Rim, does really form fantastic opportunities. And you can see by the slides or the details on there, that we're involved in doing 100,000 transactions a day in that neck of the woods. So absolutely a vital market, and an area that companies are looking to sell into in greater volumes. If you look at the sort of, and this is the only two sort of countries I'm talking about, or two areas, USA, again, fantastic opportunities, still the largest country for UK exports with about 19% of overall. I mentioned before about language barriers going into different territories. Of course, what you do have is the same language in the USA, well almost, and the availability of financial information, and of course no political risk scenarios there. So again, you can see our involvement and importance that we place on a market like of the USA. So helpful solutions, and this again just very, very quickly, just running through some of the external facilities that are now available through the banks. And one is, and I mentioned before about Plan B, if things go wrong, you've exported, you don't get paid. In partnership with Tradius, the world's largest credit insurer, they do operate this facility of debt collection in overseas. And as you can see, they're covering 40 countries, and there are minimal costs there for collection of an overseas debt. I mentioned also jargon as letters of credit, and of course for experienced people who are on the phone will know what that is. For those companies who haven't exported before, it is a guarantee of payment from a bank overseas. And what we can do is we provide a documentary preparation service where we work with customers right from the start of that contract and help them get their documents correct in terms of payment under the likes of a letter of credit. And there are other external organisations who provide this service, the likes of the local Chamber of Commerce, and also external companies also provide this. But the main aim is certainly to get your documents right. One of the other things, and this is why I talk about investing in your business of importing machinery. A lot of companies want to compete in the export market and require new machinery. They need to be more efficient to compete, and they need higher output capacity. So again, we have put facilities in place in conjunction with our asset funding subsidiary Lombard of actually doing an end-to-end facility where we effectively buy the machine on behalf of our customer, and we are then paid from the assets of a lease purchase agreement once a machine has been installed and commissioned. So it's helping customers obtain new machinery without effectively having any capital outlay from their cash flow. The next section, secure export funding. Now, again, I know this will be covered by Hugh later. All I would like to say is that this is a fantastic development on behalf of the government, providing support to the banks to enable us to increase our level of funding to exporters. And this is a fantastic development for the SME market, and I'm sure Hugh will cover that in much detail later on in the presentation. And moving on to my final slide is, what else is available? Local experts, you can ring us on a hotline. We do provide a guide to international trade, which is free to anybody who wants it. So you can request that through the webinar or through Open to Credit, and we will send out. And also there are a couple of web addresses there which will give you a lot of information on the risks associated with international trade.
Gordon,
thank you. Yes.
Gordon, we've got a couple of questions that are coming through on a variety of the things that you've talked about. I'll try and group them together so that you can answer.
Okay.
One of the more general questions is that a lot of what you've talked about seems to apply primarily to people shipping goods internationally. And so the question is, if you're in the services business, if you've got more intangible products or you're doing something like consultancy, then how do some of these concepts apply? Does it still work? It's just a different thing that you're invoicing for, or do you have to think about it differently?
Well, I think at the end of the day, there is a lot of commonality between goods being shipped and services being provided, inasmuch as if our customer is effectively the exporter, i.e. providing service to an overseas buyer, you still have the same risk in terms of how you will be paid. The instrument of payment, or again going back to the risk ladder, if it is on open account, you then need to look at who it is you're dealing with, what their financial capability is of paying those invoices. If it is for a service that could be run, for example, over a 3-4 month period, then you can still use some of those instruments of payment as a guarantee that you will be paid once you have completed the service that you are providing. So, albeit, yes, it's not a physical a product that is being provided, but a service industry may still have costs up front in terms of research and development for that contract, and of course, a payment mechanism to get paid for services provided. So, albeit slightly different, but some of the principles still apply.
I think the specific that's behind the question is that if you're in services, particularly things like consulting or work where you're generating something over a project of several months, let's say some technology or something like that, you'll often get staged payments. There's no physical delivery of goods, and therefore there's no single date when the transaction is complete, or even if there is, it's spread out over a period, and so you're looking for payments along the way. Does this lend itself, the kind of products and support you're talking about lend themselves? So, for example, if you've got a disagreement over a stage payment, can you still start using people like Atradius and some of the others to help with that? And can you start to use some of the products you've talked about?
Yeah, I mean, the bad debt collection side of it effectively is what it suggests. It is a bad debt. If a company has done some service and there is a dispute over that level of service that has allegedly been provided, then you would generally look through the contractual conditions with your buyer to resolve that for you to get paid. But against stage payments, and this is quite common within the service industry, going back to the simplistic idea, if you have provided a product or a service, then you do expect to be paid. So the mechanisms that I have mentioned can be extended, where you could deal on open account trade, for example, with some form of bank guarantee in the background, that if your buyer refuses to pay, albeit you have completed your service or your consultancy side of it, that you can then make a claim against their bank purely for non-payment. So all terms of payment and all mechanisms can be applied to almost anything, and it does come down to what the contractual conditions are, what you as a customer want to negotiate with your buyer, and what your buyer is prepared to accept. So you can apply all of this to a service industry.
That's very helpful. What I'm going to do is launch the next poll, and while it's up, I'm going to ask you another question, just very briefly, a very specific one. But first, the next poll is about where people usually direct their finance queries. And so while people are looking at that and selecting their answers, the specific question that came up while you were talking was this thing about funding machinery. If you fund machinery using the approach that you've talked about, does that get in the way of things like receiving funding from the EU, for example, where you get grants or other funding to support you on that purchase? Do the two work side by side, or is it more one or the other?
No, they can. I mean, certainly there has been a series of programs called, which have been running, which is called the Regional Growth Fund. And for a company who, for example, is buying new equipment to increase their efficiency, and as part of that, they may be increasing their workforce, where there are grants available, that can be combined into the likes of the machinery purchase facility I mentioned earlier. And certainly we have a number of those that we have done, where there's been a 20% grant, for example, come in from the Regional Growth Fund, that can be applied to that type of product. And what that means is that there is, if it was £1 million machine, if there was 20% funding, then what we're looking at is an overall quantum of debt of 800,000. So certainly that can be applied, and that I cannot imagine would not apply to other levels of grants.
Great. All right, so we've got some answers which should help with our next speaker to some extent. I think what we're showing is that banks are still seen as a very important place to go, and increasingly, of course, the internet. But what we are now going to move on to is Hugh Francis from one of the categories. They're a government agency. Hugh works with UK Export Finance. He spent the last 20 years working with SMEs, both advising and lending. Started his career in banking, working with corporates, and he spent some time setting up some trade services for Bivy Financial Group. Hugh, if you could take us on to your slides, we'd love to hear from you.
Right, thank you, Oz, and thank you also, Gordon. Good afternoon, ladies and gentlemen, and welcome to the webinar. If we could move on to the, there we go. Right, my name is Hugh Francis, and I'm the Export Finance Advisor for UK Export Finance covering the Southwest. And what I'm looking to do today in terms of the objective of this presentation is for you all to have a basic understanding regarding UK Export Finance, what the organisation does and how it does it, and how the government might be able to assist you through UK Export Finance. In terms of how to contact us, I've also attached my contact details at the end for future reference. I thought that the best way to make this presentation would be to give a quick summary as to UK Export Finance's framework and background, and then to look at some of the government's export schemes that are most in demand at the moment. So, with the UK background operating framework, UK Export Finance is the operating name of the Export Credits Guarantee Department, the old ECGD that some of you may have heard of, which is the UK's export credit agency. It was created in 1919 to repair damage done to export markets after the First World War, and has been asked to step in and assist with the SME market following the problems in the credit markets over the last few years. It is a government department that operates under an Act of Parliament, and it is headed up by Lord Green, Minister of State for Trade and Investment. As Gordon's already alluded to, the aim of the government currently is to double exports to £1 trillion by 2020, which will result in an increase in the numbers of exporters in the UK from 1 in 5 to 1 in 4. The target market is very much SME companies and SME exporters, and I've put here approximate turnover, £1 to £2 million per annum, up to £50 million per annum. So that gives you a very wide range in terms of the kind of companies we're assisting. The companies utilising the government schemes will tend to be either established businesses or fairly established businesses with minimum 3 years audited accounts for underwriting purposes. The routes to the SME market for representatives of UK export finance will be via banks, accountants, credit insurance brokers, international trade advisors at UKTI, and directly, for example, when you go to the UK Export Finance website to try and access information and get information about exporting. What the government tries to do is to complement but not compete with the private market. What this means is that the government is not looking to lend money directly, but is looking to get credit for exports flowing either directly via the provision of credit insurance or indirectly via the existing bank network, for example, through Gordon at RBS. Moving on. This gives you, these are examples of overseas markets where the government's been able to assist UK exporters sell their goods and services. It's not a comprehensive list, but it's intended to provide an indication of some of the more far-flung countries where UK exporters have been able to export using assistance from the government, whether that's credit insurance or bond or working capital support.
Hugh, could I step in for a moment on that?
Go ahead.
Yeah, on your previous list of countries, I think a lot of the SMEs that are exploring new markets and thinking about moving away from established markets, they know that their banks and other advisors will help them with particular markets, particularly where they have a presence. But I think they're unsure if there are any particular markets where they should be coming to you as well, because the country itself or the region itself lends itself to some further support. Do you have any guidance on the kind of typical places where you'd expect SMEs in particular to come to you?
Well, we're doing a lot in terms of engineering, aerospace contracts in the Middle East and also within Europe. As I'll explain in my slides further on, there are certain markets where we are excluded in terms of providing credit insurance. But on the bond working capital scheme, it could be anywhere, and it could be within the African continent, the Middle East or the Far East. But it could be anywhere in the world. And again, what we do tends to be through the banking system anyway, so it would depend in terms of whether the bank would be able to assist in those countries as well, of course.
But there's no rule of thumb or any sort of general guidance that if you're looking at country X or region Y, one would expect to end up working with yourself as well as the bank down the path?
No, I think it's more related to having the support, whether it's bond support or working capital support, to fulfill the contract, irrespective of where the contract is. I think it works that way. So looking at the products then, this is a list of products that are most in demand rather than a comprehensive list of export schemes provided by the government. If you want to have a look at a full listing, then they're on the website. But what I'll do is say a few words about each of these, which, as I say, are the ones most in demand at the moment. So if we go over the page, the export insurance scheme is basically the government's credit insurance scheme, and the aim is to reduce payment risks for exporters selling on credit overseas. Now, Gordon quite rightly said that when you're exporting, the two safest ways of doing it is to get cash up front, or to enter into get paid by incoming letters of credit, particularly if they're confirmed by a UK bank. If you can't do either of those things and you're selling on credit, then it's always advisable to check out your debtor company and also try and reduce the risks of non-payment by taking out credit insurance. What the government provides is contract-specific, single buyer, single country-specific credit insurance, which complements the private market, because credit insurance providers in the private market tend to offer whole turnover credit insurance rather than single debtor, single country insurance. We don't provide credit insurance if the risk is less than 2 years for countries based in the EU and for rich OECD countries, because it's been deemed by the EU that those markets are adequately sorted by the private sector. So what we tend to look at are private companies and debtors outside the EU and outside rich OECD countries like USA, Japan, Canada. And the current demand is we're doing a lot of credit insurance for companies in Greece, the Middle East, the BRIC nations, Brazil, Russia, India, China, South America, and former Soviet bloc countries. With regard to the credit insurance, 95% covers provided, and the risks cover the insolvency of the buyer, either pre or post delivery of goods, failure to pay within 6 months of due date, and other events that might prohibit performance of the contract or payment of sums due. There's a simple application form you can apply directly to UK Export Finance, or you can utilise the services of myself to take that through for you. If we turn over the page and look at the bond support scheme, the aim here is to free up an exporter's cash or working capital facilities at the bank to allow the exporter to take on new export contracts or complete existing ones. And a common problem experienced by UK exporters is that banks, quite rightly, often seek cash deposits to secure their customers' guarantee and bond liabilities because they could be called upon at any time during the course of the contract. If more cash is taken as security by the bank, then obviously the knock-on effect of that is that the exporter is left with less cash or working capital to enter into and complete contracts. And the whole point, what the government's trying to do is help exporters enter more contracts, not turn them away because they don't have the requisite cash deposits. So a solution is that UKEF, UK Export Finance, provides partial government guarantees to participating banks regarding a full range of bonds and guarantees, allowing cash to be returned or advanced to the exporter, who can then enter into new export contracts. Under this scheme, the government can provide up to 80% for advance payment guarantees and progress payment bonds issued by banks, and up to 50% for other bonds issued by banks, such as performance bonds. There's no real minimum or maximum. We can look at a bond for £5,000, we can look at a bond for £1 million or £5 million. Again, there's no minimum maximum term. Going back to what Gordon was saying, it could be a 3-month transaction, it could be a 3-year contract. Guarantees can be provided for existing bonds as well as new bonds, which is excellent. So if any of you have existing bonds now where cash is already tied up, then we could look at providing guarantees to your bank to release cash to you now. The application for the bond support scheme is through your bank, through the participating bank, and in addition to credit insurance, which we've already discussed, you can also take out through the government bond insurance policy, which insures you against unfair calling of bonds.
And then moving on, very last point about the bond insurance. If someone has a situation where they've put up one of these bonds, it's been issued, and then there's a dispute about whether it's actually valid. Let's suppose it's some sort of performance criteria on delivery of a staged payment or something, and there's a dispute. Does that dispute need to get settled in the country with the customer before the insurance pays out or the bond comes into force? Or do people sort of get straight on with it, move on to the next thing, and then fight the litigation in background?
Well, if the bond's called and the payments, as soon as the bond is called, then the bank would be obliged to pay under its guarantee, and it would be, we would then enter the process of making good under the bond insurance policy, whilst also trying to find a way in terms of rectifying the situation that exists in the external country.
Okay, so if someone,
but it's a fairly automatic process.
So if someone sort of almost unfairly on the customer side says, you didn't deliver, I'm calling that bond, the person at this end, the exporter, doesn't really stop trading. Everything carries on supporting them. And then while they're running their business, they have to sort out this problem in the background. It doesn't sort of slow everything down and stop it going. Is that correct?
Well, no, because if the bond insurance policy has been taken out, then there's an automatic process in terms of the bank paying and a claim being made on the bond insurance policy. But the problem with issuing bonds is that at any one time there could be unfair calling of the bonds, and unfortunately it does happen, which is why the banks look at the security and say, well, the bond could be unfairly called at any time. That's why we need a cash deposit.
Got it. Thank you.
Okay.
Yep.
Going over the page then, the Export Working Capital Scheme works in exactly the same way, not in exactly the same way, but in a similar way to the Bond Support Scheme, in that government guarantees are involved. And the aim here is to assist an exporter access sufficient working capital in order to take on and fulfill an export order, because the government's trying to grow the export market and export trade for UK PLC. The problem that a bank may have, it may be asked to provide a funding request, and for a number of reasons. For example, if the credit line's too big, or this is a large one-off order, and there might be too little security within the business, then the bank might be prohibited from providing exactly what their customer needs in order to take on board this contract. And the solution here would be for UK Export Finance to provide a partial guarantee to the participating bank to partially cover credit risks associated with working capital facilities for specific export contracts. So we're trying to all the wheels of finance and get credit flowing by providing the guarantee to the bank. The working capital facility provided by the bank has to be a structured working capital facility, such as a loan or pre-shipment finance. It can't be an overdraft, because under the 1991 Act, everything that we do has to be export related, and overdrafts can be used to pay salaries and other overheads that aren't specific to the export contract. The government guarantee to the bank can be up to 50% of the working capital facility provided by the bank. So this is ideal for larger than normal contracts, seasonal contracts, or when an exporting company wins more orders or contracts than it was expecting and wants to try and enter into all of them. Okay, and the government doesn't want these turned down. It wants there to be a process whereby all of the orders can be taken on. There's no minimum contract. The minimum contract value is 25,000. There's no maximum, and the maximum term is less than 2 years because it's classified as a short-term product. And again, as with the bond support scheme, application is via the participating bank. If we go over the page, the foreign exchange credit support scheme is linked into the working capital scheme. It's not standalone. And what this basically is that where the export contracts in the foreign currency, if the exporting company reduces its forex risk by entering into exchange rate contracts, and Gordon alluded to this again and mentioned it in his presentation, then if the exporter reduces the forex risk by taking on its forward rate contracts or exchange rate contracts through the bank, then the government views that as prudent management and will increase its guarantee on the working capital facility from 50% to 75%. And the terms of the working capital facility still stand, so it'd have to be a structured structured finance or facility or a loan facility. Moving on, the key points of these schemes for you, the exporters, there's no cost to the exporter. So for the export working capital scheme and the bond support scheme, there's no cost. What there is an income share between your bank and the government for the element of risk that the government is taking on. So the banks therefore pay a premium to the government for underwriting part of the bank's risk, and there's no cost to the exporter. There's also no security requirement from the exporter by UK Export Finance. There's a simultaneous credit process between the bank and the government, which is why we need 3 years audited accounts, for example, because there will be an underwriting process to make sure that everything's okay in terms of providing the guarantees. And you can use myself in terms of putting things in place and arranging these schemes and putting them in place. There's a team in London, but you can also go through myself, the Export Finance Advisor. That is really the last scheme. So all of the above is really a quick run through of some, not all, of the government schemes to assist the UK SME exporting companies. And as I said earlier, a full list of the government schemes is available on the website. If you would welcome any further clarification or would like to discuss any of the above on a one-to-one basis, please feel free to contact me using my contact details attached. And thank you for listening.
That's very useful. What I'm going to do is launch the next poll, the last poll, which is trying to understand whether people have ever turned down orders based on this kind of topic. And while that's happening, there is one question. I think most of your questions have been answered during your speaking. But there's one question that's been asked, which is that the way you work with the banks, which is very much the bank kind of starts off the conversation and then you come to support the bank's decisions and products. Is it possible for people to come to you before they've got to a specific order, when they're considering the kind of markets that they're looking at, and have a chat about the kind of risks that might come on later downstream and just share your experience of a particular market or region? Is that something you're able to do, or is that not quite fit the business model?
Yes, absolutely right. People can come to us at any time to discuss things like that. And if they provide us with 3 years audited accounts, if I have a little bit of information about the contract and 3 years accounts, I can send those up to the underwriting team and get some initial feedback in terms of their appetite. And if it's good, then obviously I can tell the exporter, and he can chat to his bank and say, you know, perhaps we can look at this government scheme in the background. And if the bank would like us to get involved, it could be that the bank can fund the contract itself, but if it would like the government to get involved, then we can start talking to the bank at an early stage as well. So yes.
That's very useful.
You know, exporters can speak to the export finance advisors about anything at any time. I think I speak on behalf of all of us for that.
Sure, because I think what people are saying is that they want some of these decisions thought through before they just take the journey into the market, if you know what I mean, because they're not quite sure whether they should start if they find in 3 months' time they've got some very risky products that they can't get underwritten. And so I think that's something that what your answer has done is really helped out very much.
Yeah, good. I mean, we can have discussions early on. There's no problem there.
Fabulous. So the answer is fairly evenly split. There has been a request for Hugh's email address. What we're going to be doing is putting the slides from the webinar up on Open to Export in the next 2 days, and you can get everyone's contact details back at that point. Hopefully that'll be okay. And at that point, we're going to move on to the final speaker. We've now got Sanjeev Chugani, the co-founder of Billbus. Sanjeev is a very experienced corporate financier who's helped businesses, corporates, banks, and the public sector grow by raising finance over the last couple of decades, and he also used to be a banker. Sanjeev, if you'd care to share your please.
Hi, Waz, thanks for that. So everyone's heard a lot from UKTI Export Finance as well as RBS. So I'm going to take a slightly different angle now and talk you through Billbus, which is an online hub to let you get businesses on top of their financial priorities. So really we're talking the cash flow visibility, which is about getting paid, and then the access to funding, which is about financing orders in this context. So, oops, I moved too fast with that, and I think I'm faster than the lag. Yeah, fantastic, thank you. So cash flow for all of you businesses is really one problem with 3 parts, which is getting paid, the cash management forecasting, which relates to when your customer is going to pay you, and then obviously finding finance. So it used to be that we got all our financial needs through a single bank in the past. Today we actually look through different avenues to solve our segmented needs. And in terms of getting paid, thank you. We go through varying degrees of pain depending on how your customer pays you. And you saw the chart, the graphic earlier on in terms of varying degrees of risk, with credit terms, as you can see, on open account being the biggest pain that businesses would face today in terms of risk as well as the effort to get paid. And when you are following up, chasing up your invoices on open account these days is a lot of work. Whether if you're doing exports, it's a lot of emails and phone calls, and if you happen to be able to visit them, quite often we had people that would actually go and visit their customers and take them to lunch just to get paid. Then the process of actually managing your forecast to work out when that translates into cash issues for you is also a time drain. So the next thing is, once you've figured out you need funding, you're looking for it in different places. And that basically, as a business, you'll try different sources, and whether you go to your bank or you go to an alternative source of funding, and I think there'll be a webinar coming up on that pretty soon, in the next week or so. Depends on your situation at a point in time, and what's suitable and available to you today is not necessarily the same tomorrow. Your actual funding needs vary depending on what you're doing and whether you need order financing and short-term funding, which is related to your exports now, or whether you're looking to gear up and get funding for a more medium-term situation. To get the equipment and the plant you need, or if you're looking at long-term, again, depends on the risk appetite of what you've got, your investors and your lenders have got, and what your own goals are as a business. Shopping around, getting all the paperwork you need to get a funding, whether it's an order finance or trade finance, or simple invoice funding, is quite time-consuming and quite often takes you away from the day-to-day tasks of running your own business. So you need lenders that understand your business, and I think you've heard from one that has a good range of products. So enter Billbus. Accounting platforms are great at showing you where you've been. What Billbus does is start from today. We're a cash credit hub that syncs with your accounting, manages your receivables, automates your cash forecasts, and connects to lenders, all online, all in one place. So getting paid and shopping around for funding in a single cloud-based dashboard that connects with your accounting platform. So we sync invoices, we create auto reminders to remind your customers that they owe you money, which then automatically goes into your Billbus system to populate a cash forecast, telling you when you are likely to run out of money. And when that happens, you can then decide how you're going to apply. What we do through Billbus is we can match you to a credit match you directly to a loan officer and an asset lender, or a commercial finance fund, or even a bank. We're pretty much lender agnostic at this stage. That has already shown an interest in the kind of business that you have. And based on that matching, you're able to then speed up the conversation with that lender, give them all the information they need online, take the conversation online, or offline, or continue it online, and you decide how you close the loan with the lender you want. The type of fundings we can connect you with are order financiers, invoice finance, revolving lines of credit, term loans, with lenders today based in the US and the UK. Moving to the next slide.
There's a question on that previous slide where you've talked through one aspect of the proposition. A lot of SMEs, particularly when they need a lot of hand-holding getting into export markets, they really value their relationship with their bank, with their advisor, and the relationship itself goes beyond the products, and often people will have a portfolio of things across, but that relationship is key. Does this way of speeding things up that you're talking about get in the way of that relationship at all, potentially?
No, it doesn't. And the reason it doesn't is we are looking at ourselves as the cash flow hub for the business, and we're connecting the business not only to its customers through the invoicing and the auto follow-up, and then connecting the business to its own account information. But we're also then making it easier to interact with the lender. So if they're actually interacting with their own, if you're a business and you have a relationship bank that's already told you how you want to get things done in an export market, then really it's a question of using Billbus to get that documentation to your relationship manager quickly. However, if your bank person can't help you, then that process of shopping around and finding another bank or another source of funding can take time you don't have. We can help with that too. Did I answer your question?
Yep, that's fine.
Great. So I will take you through a quick run through, and really getting started on Billbus is simple. You connect to your accounting platform, you sync your invoices, it automatically comes in. As soon as that's done, if we go to the next slide, each invoice you can set an auto reminder. So a lot of people right now hire part-time staff quite often just for the simple process of calling people up and saying, did you get my invoice, and is there any problem with that, and when you're going to pay me? So we can actually speed that up automatically, either via email, or if you're sending in a supply chain directly to a customer's invoice portal, then we can manage that too, whether it's EDI or an electronic invoice format. Once you're done with the invoice reminders, then your cash forecast is something that we automate as well, so you're not having to manually update when someone says they're going to pay you into a cash forecast. That shows up in Billbus. What that also does is highlight to you when you're going to need money or likely to need money, and it allows you as a business to put some scenarios depending on what you think are going to be payables and receivables in the short term, and based on that you can say, okay, it looks like I'm going to need funding. You talk to your advisor, whether that advisor is within your bank, or if your bank is not able to help, you look for someone else outside. Maybe it's a long-term financing and your bank's only really offering you short-term or medium-term, whatever the case may be. You then decide you want to shop around and try and find the funding. The next slide shows you a very simple depiction of how we do it, which is you put a simple story online, you put all your information in one place. That information gets matched to lenders that have already indicated their criteria for what they'll do, and that therefore the person that is talking to you is actually someone that's already done some of the homework on your business and said, okay, you're someone that meets my particular lending and risk criteria today, and you're going to a market that we can deal with. And once that's done, the conversation basically gets shortened to, rather than you finding the lender that is interested in talking to you and knocking on lots of doors, this shortens that process, as well as the information exchange, which then means that when the lender's talking to the business, they're actually having seen your electronic information, can then ask more interesting questions and get to the stage where they can make it a helpful conversation.
So we've got another question coming in at this point. It goes to the fact that a lot of SMEs are very good at what their core business is, their products or their services or their technology. When it comes to the finance, they're often not masters of the subject, and so they rely very heavily on their accountant, whether it's outsourcing things like managing the books and knowing when the invoices are coming, right down to when the bank wants some information, they just say to the accountant, I need this stuff, can you get it? And that's often outsourced, it's not just done on their systems. How do you work with, particularly when it's outsourced? Because it sounds like a lot of this, the SME has to do it themselves with you.
Yes and no. So to answer your question, an SME can do this directly with us. They can also do it through their accountant. We actually are rolling out an accountant module where the accountant is able to make it much easier for the business client to access the information themselves, at the same time share it with the accountant. So the accountant also finds this process of giving information to the lenders often quite time-consuming, especially if lots of clients want it at the same time. And what Billbus allows the accountant to do is see the cash flow and the collections information, since we're involved in the day-to-day invoicing process, and then add in whatever documents they want onto the Billbus site. And therefore, the lender is able to actually, rather than ask the accountant lots of questions individually, it's also helping the accountant get this out quicker. And more importantly, it helps the accountant either have a better conversation with the client, because the client has already seen some of their cash flow information as well as the accountant, and therefore they can sit down and decide, well, this is the kind of thing we should do next. So absolutely, Billbus makes the accountant a key part of this process. But there's an option to not use them if the business already has in-house finance.
Thanks.
Okay, so the reason that we spend so much time on getting the invoicing right and the cash forecasting and the auto reminders is simply because in today's credit environment, the real-time collections is really a key part of the credit assessment process for lenders. It makes a business's credit case much stronger to see how it's collecting and how well it's doing. And also, many of our lenders, which range from asset financiers and commercial debt funds as well as the banks, like to see where the business is going rather than where it's been, and Billbus then helps this process easier. Helps this process become easier to both sides. So my final slide is really to sum up and say I've given you a quick summary of how we simplify cash flows and put all the top financial tasks into one online cloud-based hub, allowing businesses to automate how you follow up open account sales, whether export or domestic, manage cash flow forecasting, and obviously arrange the funding as and when you need it. If you have any questions, or if anyone has any questions, please send me a quick note from the Billbus site, and I'll make sure that I personally respond to you. I think that's about it, unless there are more questions. Thanks for listening.
Yeah, that's been very helpful. What I'm going to do is move on to the slide where we talk about our next webinar so that people can see the final webinar in the process. And then I'll pick up on a couple of questions if we've got time. Certainly there's time for the first one. And this is primarily for Gordon and for Sanjeev. I think, again, what's behind the question is a lot of SMEs, particularly in some sectors, run on incredibly tight margins. And anything that suggests that something needs to eat into that margin, the instinct is to run the risk, go without the extra cost, and hope that nothing bad happens. And it sounds like both of you have been suggesting there are products and there are mechanisms that you can help with the reduction of risk, but it comes at a cost. But I think people are struggling to understand, what does this really do? If I'm running a business at 5% net margins or 10% margins, is this going to take a fraction of a percent off? Is it going to eat in significantly? Do either of you have a view on how much of your margin as an SME will be absorbed in the interest of trying to improve the risk? Gordon, do you want to go first with that?
Yeah, hi, sure. I mean, I'll pick up on that. And I mean, cost is always going to be related to risk. And if there is what is perceived to be a higher risk, you would expect there to be a higher cost in terms of the charges that the bank will make. But, you know, for somebody who is running on high margins, you know, you could argue that out of the high margin, purely to take the risk away, it is better to take, you know, 1%, 2% of that margin to ensure that the business that you've transacted actually does become business. And that is only business once it's been paid for. Also, for companies who are operating on a small margin, the actual effect of a default on payment has a much more serious effect on the overall cash flow of the business. So, you know, it will always depend on what that risk is. It will depend upon what the period that risk is going to run for. It will always depend upon what the value of that contract is. But generally, the banks are there. They will assess the charges based around the risk and the level of funding that we are being required to provide.
That's very helpful.
That answers your question, yeah?
I think it does. It certainly gives people another way of thinking about it rather than just the bottom line. Sanjeev, do you have a view on that?
Yeah, I do. I do. So I guess as a finance person, I would say that your financing costs, because you've got two costs. There's one cost of getting paid, and the second one where exports are concerned, and the second cost is actually the cost of funding. So if we take cost of funding, you will have your cost of funding can be viewed in two ways. If you're trying to get money to get paid earlier because your customer pays you in 120 days, and you'd like to use invoice financing or some way to get that money in your bank account quicker, then really that funding is a cost of sales. So you decide as a business, if the customer is creditworthy, you're willing to wait longer. If they're not creditworthy, then there's not only a matter of managing the risk, but you're also getting that funding in your cash flow faster, which means that you can turn that money around and either produce more or do something else with it. And then the second side of funding is obviously, as a long-term funding, it's more of a cost of business. And as a business, and you talk to your advisors, you talk to your accountant, and you'll make up the decision as to what makes sense at that point in time. In terms of getting paid, which is again getting back to the risk issue, and whether you're trying to protect against default or you just want to make sure that the money gets into your account, all business, I had put a chart up earlier on talking about the pain of getting paid. And even something as simple as credit cards costs a business a fair amount of money, and that goes into the margin, right? I mean, you're talking about 4 to 5% of your sales on something as simple as credit cards, whereas if you're selling on open credit and you're getting an invoice finance facility, that cost may actually be lower. So it all comes down to what you want to do with the funding and how fast you need it. I don't know if I answered your question.
I'm going to have to wrap up because I'm conscious that we're just over time. We've been talking about finance. On Wednesday the 29th, there's going to be a webinar where we look at alternative sources of finance, just to give a very complimentary view to some of the things that we've been talking about today. But with that, thank you very much, everyone, speakers and audience. Really appreciated your time. And if you get on to Open to Export, then we can continue the conversation through Q&A on there. Thank you very much, everyone. Bye-bye.
Thanks. Bye-bye.